Okay, under the category of current liabilities are things like contingent liabilities and payroll accounting. Contingent liabilities means things that might happen, and payroll accounting comes about whenever we pay our employees, we have to withhold some money and turn that money over to the various government agencies. So contingencies are bad things that might happen. Remember, we're preparing our financial statements to answer the question, how did you do? So we can tell our existing investors and our prospective investors, those are our primary targets for these pieces of information, how we did, so they can make predictions about how we're going to do. So if we know there's some bad news on the horizon, we should probably tell them about it. And what we tell them and how we communicate it depends on what kind of probability there is associated with those events. So we as accountants have to make a decision whether it's probable and reasonably estimated, whether it's just reasonably possible, or whether it's a remote possibility. If it's probable and reasonably estimated, in other words, if we're in the appliance business or the automobile business and we issue a warranty with our automobiles or our appliances, it's probable some folks are going to come back and need warranty work, and if we've been doing this for a while, we can make a reasonable estimate of what that warranty expense is going to be. If it's just reasonably possible, suppose we own a patch of land that's upstream from some other land that's been contaminated, and it could be the contamination would be coming from our property or a couple other properties. It's reasonably possible, but it's not probable. So we should footnote it. What does that mean? It means in addition to our financial statements, in addition to our income statement, our statement of owner's equity, our balance sheet, and our statement of cash flows, we have some words that go along with those financial statements. And in those words, we should talk about this contingency, that someone is asserting that we are liable for the contamination of their land. What if it's remote? Suppose we manufacture aluminum foil and somebody sues us because he says our aluminum foil wasn't thick enough to protect him from the Venusians stealing his brainwaves. Well, we don't have to report that anywhere. And a fair question might be, suppose something is probable but we can't estimate it. Well, then we should talk about it in the footnotes. The footnotes are an important way for us to communicate to existing investors and potential investors exactly what has happened and what might happen to our company. So let's take a look at an example of something that is probable and reasonably estimated. Warranty expense. We sell washers and dryers this year and we offer a 1-year warranty. We know that someone's going to come back for warranty work and we can estimate it to be $40,000. So we debit warranty expense for $40,000. Expenses are debits, expenses are debits, expenses are debits. And we credit a liability account called warranty liability. This would be a current liability because it's going to happen next year. So please note that we aren't going to be paying anybody. We aren't going to be replacing any parts. We aren't going to be doing any work on these washers and dryers until next year, but that expense shows up in this year with this adjusting journal entry. And that way we match our expenses and our revenue. We get this expense into the same year that we earned that revenue. And then let's just have a quick introduction into the topic of payroll. We all know that if we're supposed to get paid $3,000 of gross pay, when we look at our paycheck, it's closer to $2,000 or lower. And the reason is because our employer withheld payroll deductions. They withheld, say, union dues. They withheld FICA taxes. That means Social Security and Medicare. They withheld estimated federal income taxes depending on how many withholding allowances we checked. They withhold state and city income taxes depending on how many withholding allowances we checked. And maybe they withhold some money for charity. And once the employer withholds those monies, they create a liability on their balance sheet, a current liability, because they've got to turn those monies over to the feds and to the state and to the local charities. So you as the employer might have salaries and wages expense of say $17,000 on payday, but you only write checks for $11,000. The difference, the $6,000 difference between the expense and the checks you cut are income taxes payable, FICA taxes payable, contributions to charity payable, and things like that. Those are current liabilities. So contingent liabilities, how we treat them depends on whether they're probable and reasonably estimated, possible, or remote. And payroll accounting involves cutting checks to our employees for less than the total wages expense and withholding from their checks amounts that have to go to the federal government, or the state government, or maybe the pension fund. And you could take an entire class on payroll accounting. For the purposes of this class, we just need to know that in the moment that the payroll checks are cut, we create a liability on our balance sheet, and that's a current liability. That's all there is to it.